Hey guys, welcome back once more. So today I'm going to show you how to do the covered call on TD Ameritrade, how it works and how it can give you some downside protection as well. Now again, I'm going to explain this in plain English just to make it easier on everyone, and that's just the way I like to do all my videos, in plain English as best as I can. So on TD Ameritrade, if you're not familiar with a covered call, by the way, a covered call is just using the stocks that you already own as collateral and to try to sell them at a strike price between now and an expiration date of your choosing. And when you get in those contracts, you're giving the buyer, some time for the price of the stock to move either in their favor or, hopefully that's what they're hoping, in their favor, and you're hoping that it doesn't really go that way. And if it does, then you get to sell your shares at the strike price. But then that's not really a bad thing, and I'm going to show you why and how it works. Now, again, in order to do a covered call, you have to have at least 100 shares of the stock in your portfolio. Now you can have 200 shares, 300 shares, and then you can do 3 contracts. So it's 100 shares for 1 contract, per contract basically. And I'm going to give you a quick example. So I have 100 shares right here of AMD, which I bought at an average price of $33.51. So we'll say $33.50 to keep it easy. That's how much we paid. So our investment is $3,350, roughly, give or take a few, of course. Now, if I were to sell the shares right now of AMD, I would only make this right here, $28, $29. The market is open, so you're going to see this fluctuate up and down. That's how much we would make by simply selling them right now. And of course, we don't want to do that because we know we can make more money by selling a covered call. Now, for most new investors, they think that the only way to make money is if the price of the stock goes up. Buy low, sell high. That's one way. But then I'm going to show you another way that you could make even more money. Now, with the covered call, like I said, you're getting into a contract between you and the buyer of the contract. So we're gonna go here where it says trade and options chain. And I already have a covered call in there, and I actually went on a monthly one. Now you see all these dates right here. That's how far out into the future you can go with these contracts. Now I'm going to give you a quick example on how much you could make. Of course, I don't recommend these are deep out the money covered calls, and I do not recommend doing these because even though it might sound tempting, this is a lot of time to give the buyer for the price of the stock to move. Yes, you might get paid more on premium, but I don't recommend doing these because also I think that the weekly and monthly ones you get a lot more money, throughout the year than doing a single deep out of the money one. So deep out of the money is basically anything, very far out into the future above the price that the shares are trading at right now. So I'll give you a quick example just to show you how it looks. So if you were to write a covered call on the 21st of January of 2022, yes, that's how far you can go on AMD. Now remember, we paid $33.50 for the shares, okay? Now if you are okay with selling them, this is the strike price right here. If you're okay with selling them at $35 per share between now and January 21st of 2022, you would get credited $10.65 per share. That's why, so don't ever think it's like, oh, $10.65. This is the price per share. This is the ask right now, and this is the bid. So something, let's say roughly $1,000 right now, because the bid is $950, and then the ask is $10.65, which would make it a little over $1,000. If you were to sell this contract right now, you would get credited roughly $1,000 into your account right now. Now again, this is until January 21st of 2022. That's a long ass time. Now, just because you sell a contract covered call doesn't mean that you have to wait until this date, with your money tied up. It doesn't mean that. All it means, that's how much time you're giving the buyer. You can always get out of a contract by simply buying the contract back. Of course, you want to buy it, where you're at least going to make some money. So let's say if you were to do this, you get credited $1,000 into your account. And let's say the price of the stock falls all the way to $28, $25 between now and next month. So that means this contract that you got paid $1,000 for, it's going to be worth less now. It goes down to, let's say, and these are just rough estimates because I can't do the every single little math detail. So let's say it goes, you see how it's fluctuating. So if the price of your stock goes down, this contract is only going to be worth maybe $900, nine something, 800. It depends how much it goes down too, of course. So let's say if it goes down to $25 between now and next month, as an example. So because it's cheaper now you can actually buy the contract back using the $1,000 that you got paid. So if this is worth $900, you can buy yourself out of the contract for $900, and you end up keeping the difference, those $100. So that's what I mean. When you're writing a covered call, it doesn't mean that you have to let it expire, or you have to wait until that time. You can always get out of the contract. So if you got out of the contract, you can write another covered call. Like I said, you're gonna see these enticing and lucrative premiums, and I wouldn't recommend doing deep out of the money calls, but that's just an example on how much you can make if you were to do one deep out of the money covered calls. I tend to do them only monthly, weekly, bi-weekly. So the one I did was the 29th November of this year, and I only tend to do weekly, bi-weekly, and monthly on AMD because I think it's more money throughout the year. I can make in 1 year I can probably make more than $1,000 doing covered calls than just doing a single, or more, of course, than doing just a single, deep out of the money covered call. So this is where I am right now at $34 right here. So I bought the shares for $33.50, and between now and November 29th, I'm okay with selling them at $34. Now by selling them at $34, I'm going to make $50. But that's not the only thing I'm making. Remember, I got paid the premium. So I got paid around $200 for the contract. So that's, by letting it expire, I'm going to make $200 and the 50 and the capital gain. Now if it expires above $34, let's say the price of the stock went to $35, I'm only gonna be able to sell them at $34 because of the contract. So if it goes up to $35, I'm gonna make $250 and lose out on that extra $100 that I could have made. Again, that's you could have made because you don't know, right? Now, doing the covered call also gives you downside protection. Why? Well, you wrote a covered call. I got paid $200. Now, if the price of my stock goes down, those $200 are still mine. It doesn't matter. The option is gonna expire worthless because it never went above $34. So I made $200 even if the price of the stock went down. Now again, if the price of the stock goes down, that contract that I got paid for $200, this is going to be worth less. So using the $200, I can buy this contract back for, let's say, $180, $175, and I keep the difference. So let's say it's worth $175 between now and next week because the price went to $32 or so. So I made $25 because I used the $200 to buy the contract back. And now my shares I can use as collateral again to do another covered call. So now I do another covered call. I can move into the next month, which is November. We'll do, let's say we'll do December 6th. If you do December 6th for the same strike price, let's say $34, now we're going to get $222. Well, that's the ask, and the bid is $217. So you're going to get around $220 for the following month. So you keep, buying the contract back if it's in your favor. If it's not in your favor, you can let it expire and still make that money. So this is what happens. You let it expire. If it goes up to $35 and you let it expire, you're going to make $250. If the price of the stock goes down, you simply buy the contract back at a cheaper price. You keep the difference and you write another covered call on those shares for the following month. Or if you can do it for the same month if the price of the stock starts going back up and now the contracts are worth more again. Now you keep doing this, and this is how you little by little keep growing your account. Now remember, we're only talking about one contract here. What if you're doing like 2 to 3 or 4 or 5 contracts? Now you're talking, a lot more money. You're talking about $600, $800 a month, $1,000 a month by simply doing the covered call strategy. Now, again, this is just my opinion. I think that the monthly ones pay out more rather than the deep out of the money covered calls. Now, you can do in the money covered calls or at the money covered calls, and the only time I ever do those is if I'm pretty sure or pretty confident that the price of the stock is not going to move as much, or it's even going to go down just a few dollars for quite a bit of time. Mostly before earnings, it's when I try to do those, and then after earnings, I try to buy back in and do another covered call. But that can be a different topic for a different video. But like I said, when you write a covered call, these are the basics that you have to know. You have to have at least 100 shares of the stock to write one contract. And just because you write a covered call doesn't mean that you have to wait until the expiration date to get out of the option. You can always buy it back depending, whether you sold a call or bought a call. You can always buy or sell it back. At least try to do it with a gain. So, like I said, here, let me show you again. Let's see if it's worth any more. Now, where's my position? There you go. So remember, I got paid like $200 for this. This was like $198 when I sold this covered call. Right now you can see it's above 207, 206. So that means if I wanted to buy that contract back, because the price of the stock is actually going up, I'm up. It's good that it's going up. I'm okay with that. Because the price of the stock is going up, now that contract, it's getting more expensive. As you can see now, if I wanted to get out of the contract, I would have to pay a little bit more, around $8, $10 more to get out of the contract. And of course, I don't want to do that unless something happens and I think, oh, it's going to shoot up, it's going to skyrocket, and I was pretty sure about it. Then I'd get out and then wait for the price of the stock to move in my favor and then maybe sell the shares like that. But unless I was pretty sure, then that's the only reason I would get out of the contract. But by just simply leaving it there, I'm okay with making $250 at the end of the month on one contract. And sometimes doing this with less capital will get you a lot more money. I did a video on this, I did a topic on a different video similar to this. Sometimes using less money like this, doing a covered call, will get you more gains rather than doing the dividends, holding, and I'm into dividend stocks too, the holding and collecting dividends every month. But sometimes you have to use a lot more capital to get like $8 or $10 a month, when you can simply do something like this with even less capital or a little bit more capital, but you're talking about $250, $200 a month, which is better than holding dividend stocks that pay out monthly or quarterly sometimes. So you gotta think of all these different strategies that you can do. Now, the bad thing about the covered calls, like I said again, since we wrote a covered call with the strike price of $34, that's as much as we can make when it goes up to $34. So because we bought them at $33.50, and if it goes up to 35, we can only sell them at 34, making us a $50 profit plus the premium that we got paid. So if it goes up to 35, we cannot make those extra $100 that we could have made. And a lot of people, people I've spoken to, they don't seem to understand that it's a what if the price of the stock goes, above the strike price. Because that's mostly what they say. What if the price of the stock goes higher than the strike price, and you lose out on those extra gains? Again, like I said, that's a what if. Unless you can tell the future, then you wouldn't be watching this video, right? But this is a great way to make that extra income every month. Now, you keep doing covered calls on stocks that you already own. Let's say if you had 200 shares of AMD, that's roughly $500 on here that you can make. And then, $500 can easily cover car payment, right? Sometimes you can use $6,000 to just pay off your car, and at the end of the day, you still have your $6,000. So, I'm not saying that's how it is, but it's the way you got to look at things. What makes you the most money? How can money work for you? And this is basically one of the best ways that I found that money can make more money for me. So you can use those $250 to buy even more shares of AMD if you want. And let's say if you do get assigned to sell your shares at $34, now what? Well, one thing that I do recommend and that I do myself is try to get back into the stock by selling a put option. Now, when you sell a put option, the way I look at it and the way I explain it, because it all depends on how you look at it. The way I look at it is getting the stock at a cheaper price and getting paid for it. Now, with a put, when you're selling a put option, you're getting paid money up front to put up your money as collateral if the price of the stock goes below a certain strike price. So let's say if I wanted to get AMD back, at let's say $33 this time, then I would simply write a put option on it. I would get paid premium collected into my account right away. And if it falls to, let's say, $32.50 or $32, yes, I still have to buy them at $33. But a minute ago you were willing to buy them at $33.80 or whatever the price of the stock was. So you were willing to pay even more for it. But by selling a put option, you're gonna get it cheaper than just simply waiting out. You can actually wait for the price of the stock to drop, but simply waiting is not really gonna make you any money when you can sell a put option. That's just the way I view things. I think everyone should get into stocks by selling puts first and then turn around for either a profit selling them on the market or selling a covered call or doing whatever you want afterwards. But that's just the best strategy, in my opinion, to try to buy stocks that you want. Now, when you're selling a put option, you want to do it on stocks that you already want to own anyway.